Don't forget that in the flash crash of 2020, oil prices went negative, right? The markets can be stupider than one imagines. But a 20% gain from where we are now takes us within kissing distance of $3,000. It's not a prediction. I'm just pointing out the math.
All right. Today we're having a discussion with Lobo Tiggre, which is of course someone who doesn't need any introduction within the commodity space. But for the general investors, perhaps it is great to start off an introduction. Lobo, could you shortly introduce who you are and what you're doing?
Sure. Well, first, congratulations for pronouncing it Tigre, but I used to be known as that jerk from Casey Research, so it's a step up, and that's sort of answering your question. For almost 15 years, I was Doug Casey's due diligence guy at Casey Research. I helped him write his then International Speculator newsletter, and within a few years, it really became my letter. Doug was happy to retire and collect the paychecks. So, I learned with some of the best. Rick Rule has been very generous with his time, has spent a lot of time mentoring me, and really the opportunity that the Casey brand provided me to go out in the field with world-class geologists, Lowell, Silito, that sort of folks, out there kicking rocks with them. Yes, they do lick the rocks sometimes, all that stuff that geologists do. Just an amazing learning experience, and so now I do that on my own. I'm the independent speculator now. And by the way, Doug blessed me for that name. It is a homage to his International Speculator, not a ripoff.
Thank you for that overview, Lobo. I really appreciate that. And we'll dive into your newsletter in just a bit. But perhaps we can start off with an exciting topic. You seem to be a fundamentalist who also knows one or two things about macroeconomics. Definitely enjoy your views on that. Last year, you did make the correct call for the two yellow metals, uranium and gold, as you like to call them, and both are massively up since that call. So what are the big trends that you see on the medium term, for example, heading in 2025?
All right. Well, thanks for framing it that way, because I really am a due diligence guy. I'm not an economist. I just play one on TV. But, the professional economists out there, it seems like the mainstream ones, they all have these models and they're all wrong. And so you kind of, if you're going to be a contrarian investor or an independent speculator, or I think actually any investor at all these days, you kind of have to do your own economic thinking, because the mainstream, they just keep getting it wrong. And to quickly digress, people say, oh, well, the Fed got it wrong, the Fed got it wrong. Well, by mainstream norms, like stagflation isn't possible, right? High inflation means the economy's booming. Like they have all these definitions. And so according to their definitions, they followed the rule book and did what they were supposed to do. That it's not working, it never occurs to the mainstream to say, hey, this isn't working, we need to think something else. So that's why I think about these things. I don't have a degree in economics, but I am independent, and I just try to go by the data. And I have, the quick versions is there's been a lot of scuttlebutt recently about the SOM rule being triggered. The, I think, more robust version of that is what I call the Gundlach indicator, because bond king Jeff Gundlach is the one who points out the longer-term unemployment rate, the 36-month average, versus the sort of spot current unemployment. When those lines cross, going back 80 years, that has a 100% success rate at calling recessions. And by the way, both this and the SOM rule are coincident recession indicators, not leading, meaning we're in recession now, unless this time is different. Now, who wants to bet on that, thesis, right? So the recession deniers, I think, are wrong. I think many of them are politically motivated or ideologically motivated if they're not in the administration. And I think that that's why we had such a volatile week last week. As you and I record, we had that big drop the previous Monday, 1,000 points on the Dow, people talking about emergency rate cuts and all this stuff. And everything's like, fine, okay, forget it, just kidding. But no, that tells us that the markets are skittish. I think even people who've been drinking the mainstream Kool-Aid, they see the writing on the wall. I mean, the number of bankruptcies, or just like mainstream headline stuff. Companies like Home Depot recently, their guidance talking the economy down. And before that, FedEx and UPS and Disney. And companies that supply, or the auto report, the companies that supply the economy, large numbers of people in the economy, broad retail hooks into the market and into the economy, they're all slashing their guidance. Maybe they're beating on earnings, they've cut costs or whatever, but it's the guidance that's really rocking the world right now. So this isn't just tinfoil hat Lobo saying, oh, I'm a contrarian, so I think we're going to have a recession. I think if you're not like so deeply into Team Biden that you have to see things as being great now, however they are, right? You look at what's happening in the world, and the data says things are not fine. And key indicators like the Gunlock indicator and, the SOM rule, they're telling us we're in recession now. And we all know that that only gets recognized in hindsight. The NBER declares it quarters after the fact. Oh, yeah, we were in recession. And, sorry, a long answer, but you asked, the one thing that the Team Soft Landing or Team No Landing even has hung their hat on has been this strong consumer labor, right? As long as the job market is strong, everything's fine. Well, we started to see the cracks in that last month, and they're widening this month. And so that's a big deal. I mean, we'll see. If I'm right, we'll have undeniable recession, I think, before the end of this year. That does not mean necessarily a market crash. When then what happens? Do the money helicopter flies? Lots of ways we can go from there. But that's my answer to your question. Yes, I'm still on Team Hard Landing, and I think the data is starting to show that I'm right.
Definitely interesting there. Thank you for your insights. And I believe you have been Team Hard Landing basically since the start of this year. So you're definitely stable on that prediction. Perhaps we can start to outline what it will actually mean for global equities, US equities, if that hard landing is to hit. You started referring to those helicopters dropping in, which probably is quantitative easing. Perhaps you can outline how you would envision a hard landing going, timelines, that type of thing.
Right. So the first and most important thing for the investors out there is that thing I mentioned a moment ago, that a recession does not necessarily equal a market crash. I get a lot of people who say that, oh yeah, I agree with your outlook on recession. What do we do when the market crashes? Those are not the same thing. And the Fed has trained investors for years now to expect, the Fed put. They talk it down. They say, no, there is no Fed put. But the reality is that they will respond to systemic risk, as they say. And markets crashing, banks, going belly up, that's systemic risk. So yes, there is a response. What I'm saying, though, is that markets being forward-looking, we have seen for years now bad news be good news. We could see more of that. We could see, recession. Hey, that means the money helicopters are going to fly. Buy more risk assets, right? We could actually see, it sounds insane, but markets have been insane for years now. What's to stop them from being insane again? And that kind of news producing new all-time highs in the S&P 500 or the NASDAQ or whatever. Oh, yeah, the Fed's going to cut. Buy stocks, right? So do not equate recession or hard landing with crash. The powers that be in their response will have a lot to do with how our investments work out. I think that, particularly in an election year in the U.S., the powers that be they're not going to wait for the pain. They're not going to wait for the hard landing to produce bread lines around the block or something like that. Of course, we don't have bread lines now. We just give everybody prepaid credit cards and they go in the store to avoid the stigma. But anyway, but actually that's a point. Like if you're waiting for the bread lines, you're not going to see them. It's happening, but you're not going to see it. So you can't look for that as a guidance. Anyway, my outlook to answer your question is I think that as soon as it becomes obvious, I think it's already obvious, as soon as they can't deny it, I think that's when we'll see the money helicopters fly. And by the way, this doesn't just mean Fed policy. Even if for some reason Powell grows a spine and doesn't want to go down as Arthur Burns, right? And he just keeps holding rates higher in spite of the pain. If he channels his hero Volcker, right? Don't forget Congress. Because the recession is obviously no fault of the people's own. We've already established no fault of the people's own as sufficient reason to send them thousands and thousands of dollars in stimmy checks. So don't forget fiscal policy, like our friend Lynn Alden likes to say, fiscal dominance. I think she has that right. And we could easily see an election year while the White House and Congress are, parts of Congress anyway, are aligned. It's an election year, right? So I would imagine that we would see a fiscal response. And then, so recessions are good for monetary metals anyway. So if you're a gold bug, this is good news for you. If there's no recession, but the Fed just goes into a rate cutting cycle, that's still good for gold. Cutting rates is good for gold. If there's a recession, though, that's bad for industrial minerals. And then we have to see how quickly do the money helicopters fly, how soon do the industrial minerals respond. So I have a sort of bifurcated view. I'm very bullish on monetary metals. And note what I said, like if I'm wrong about the hard landing, I'm still bullish on monetary metals because the rate cuts are coming. The Fed itself is telling us the rate cuts are coming. How closely silver follows gold, we'll see. It's behaving like a monetary metal this year. So far the data says silver and gold should be fine, even if I'm wrong. And then if I'm right, they'll be even better, right? The big question is what to do about copper, oil, other industrial minerals. And my view so far is I'm not buying any of them. I'm not investing in, I've held on to some because I could be wrong, but I'm not putting any more money into those spaces until I'm sure the recession has done its worst, which can be either because I'm right, that it becomes undeniable, the money helicopters fly and things start heating up again, or because I'm wrong and it becomes clear that I'm wrong, this time was different, the SOM rule and the Gundlach indicator were wrong, there's no recession, and it's happy days again, in which case there will be, years to profit ahead. So rather than try to time the market bottom, I'm just waiting to be sure, reasonably sure, that the recession has done its worst, and then I'll start looking at oil, copper, and other industrial minerals.
All right, very interesting thesis there. Quick sidestep into oil and copper, those industry commodities that you started hinting at. If you find a truly good valuation for a corporation, wouldn't you still be enticed to take a position even with that macro backdrop?
The general answer is yes. Like if stupid cheap prices are the trigger. Instead of trying to time market bottoms, if I'm ahead of it, am I behind it? I just see something that's on sale at 10 cents on the dollar, and it's a good solid company. They're not going away. They don't have huge balance sheet problems or whatever. Something like that just goes on fire sale prices. Yeah, I'm tempted to back up the truck on that, but the threshold would be higher for something like oil or copper. I mean, don't forget that in the flash crash of 2020, ancient history, I know, 2020, oil prices went negative. Right? The markets can be stupider than one imagines. Or as the old saying goes, markets can remain irrational longer than you can remain solvent, right? These old Wall Street adages, they're born from experience. So it's very difficult for me to try to pick up pennies in front of that hard landing steamroller, to horribly mix metaphors there. So maybe the short answer is I haven't seen anything stupid enough. Yeah, are stocks off? Or copper stocks off? Many of them are. Are oil stocks down with oil? Yeah, many of them are. Are they at fire sale prices? No. Right. So I'll have to cross that bridge when I get there. But my thought is almost certainly not. I mean, we probably won't see those until I'm right about the recession, or we won't see them at all. And I'll just start buying anyway because there'll be a compelling value.
Yeah. Makes complete sense. Thank you for your views there. I will quickly share my screen to actually share a post you've made on X, formerly known as Twitter, regarding copper exports from China. You've shared this, I suppose, for a reason, and I want to pick behind that reason. Is that this might be an indicator for an oversupply in China? Is that the correct way to think about this?
Indicator, not proof. If you look at the thing, it says, basically... unfinished and I hope my glasses on. It says unwrought and products. So products could be pipes, fittings, things made out of copper. It's still, even that suggests that they're exporting it rather than using those pipes to build houses or whatever they normally do with these things in China. And the unwrought part is what really caught my attention. Unwrought, that's just the metal. Like, why would you import all of this copper ore and smelt it and make all this copper just to send it back out again to somebody else? I mean, China's the factory of the world. They're not supposed to be exporting raw materials or really unfinished goods, base products like pipe valves or whatever. So I saw that as an indicator. And by the way, that chart was one of several in an article, all of which were bearish indicators on the Chinese economy. So the reason for highlighting this is, of course, China's the number one consumer of raw materials in the world. It's the factory of the world. And as a commodities speculator, there's hardly anything in the world more important than what China does as regards demand for commodities. So it's something we all pay a lot of attention to. And China's been in the headlines for all the wrong reasons for years now. They just are like the little old lady in the "I've fallen and can't get up" commercial when it comes to trying to recover from the COVID lockdowns. Sorry, quick point. There were people during the COVID era that were saying, oh, look at China. They could just lock everybody up and stop the spread of the germ. Isn't totalitarianism great? Or maybe there's something to be said for a dictatorship in emergency times. Well, now look at the fallout. Okay, yeah. You can crack down on those authoritarians and, get stuff done, but look at the fallout. The people are shell shocked, and they're still not. Their buying patterns are still not back to where they were before. This whole idea of China generating its own demand and not just being the factor of the world has been profoundly damaged by that authoritarian response. Sorry for digressing, but it is connected to the point. Like, China is still dealing with the aftermath of this. They're still struggling. And they are also, if the factory to the world, they're also telling us something about the global economy. So for all of these reasons, this is why I'm bullish on safe haven assets like monetary metals, but not willing to put money into industrial minerals, even ones that I know are in short supply. I know copper is in short supply. But, if China just stops building for a while and they go into hibernation mode, it won't matter if there's not enough mine supply overall. The prices will still go down. The copper stocks will still go down. And then, I'll be happy to have a pile of cash in my account to deploy.
All right. Thank you for your views on copper. Really appreciate that, Lobo. I guess to quickly summarize that, oil, copper, those kind of industry metals are kind of uncertain. And you are bullish on gold and silver because the money helicopters might come in. Perhaps we can talk about your outlook for gold and silver on the medium to long term, heading into that longer time frame, multi-years.
Okay, but before we go there, let me add another thing to the industrial minerals. There are other ones that are on sale already and may bounce back. I think lithium probably bounces back after the recession because, many hard money advocates love to hate electric cars and all that stuff. But the fact is the world is going in that direction. So we'll have to see. Lithium is not rare. Production capacity has spooled up. Processing capacity has spooled up. We'll see. But I do think there's a good chance that rebounds. Nickel, I'm less sure because the Asian producers haven't really scaled back production, and nickel's taken it on the chin. That may take longer to recover. So the point I'm trying to add is, I specifically mentioned copper and oil because I'm not worried about trying to understand the market at that point. I won't have to figure out, are we going to need more copper going forward? Right? As soon as I'm ready to buy, I'm just buying. Right? For both of those. The oil's not done, and despite the just stop oil people, we still need oil. We're going to need it for decades to come. So oil and copper are both ones that as soon as I'm ready to start buying, I do. Other things, this is the clarification, like nickel or lithium or other such minerals, industrial minerals. Oh, by the way, that includes platinum and palladium, which are industrial minerals, no matter how precious they may be. It will depend. I'll have to see when we get there, how do those markets look? So that's the caveat I wanted to add. And sorry, you did mention the other yellow metal. I should mention uranium again because it doesn't fit into either of these categories. Or yes, it is an industrial mineral, it's an energy mineral, and you might say, well, Lobo, if you're not going to buy any oil until you're sure the recession has done its worst, why are you willing to buy uranium? Which I am. And the reason for that is, while you might decide not to take that extra trip to grandma's this weekend and drive less, use less oil, you do want the lights to come on, and that's what uranium does. It provides baseload power, the sort of thing that runs hospitals and airports and things. You really don't want to run out of fuel for your nuclear power plant. So it's very recession resistant. Nothing is recession proof, but if you look at the data, you can see that uranium has held up or even increased in spot price in the last 3 or 4 recessions. So I like uranium. It's just an odd duck. It's not a precious metal. It's not a monetary metal. It's not an industrial metal. Really, it's an energy commodity. It can be seen as fuel. But one that's the last thing you cut. So I am willing to buy uranium stocks ahead of the recession. That's the clarification I'm adding. In fact, my most recent purchase was a uranium stock, not gold or silver. So I forgot, you wanted to ask something about gold again?
I'm perfectly happy with the transition. I also wanted to pick your brain on nickel, for example. So perhaps we can quickly transition into some more niche materials that are less market dominating. I wanted to pick your brain also on titanium oxides, which is a market that I've been recently researching. And it seems that one of the largest producers' base resources is going out of production at the end of 2024, currently producing roughly 5% of the world supply. Would you be interested in entering a market like that, even though it is a bit linked with the business cycle?
More than a bit, and the answer is no. But it's not just no because I'm not buying industrial minerals. So we could say that about, pick your rare earth or whatever. All of them, the answer would be no because I'm waiting to make sure the recession has done its worst. But I can talk titanium specifically, it's one of these oddball or niche markets where, as you're pointing out on the supply side, a change in one mine or one company can make a big difference to the market. But that cuts both ways. One new source can flood the market or swamp it, and you may or may not know it's coming. If it's that thing in Paraguay that UEC had, I don't know if they still had it. Like that deposit is it's so huge. It's like 100 kilometers long or something like that. It's this giant tabular thing that can supply all the world's titanium for 50 years or something in one single deposit. They're not doing anything with that. I don't know if they even have that anymore. I just remember it was also in the portfolio when they picked up the uranium assets in Paraguay. But that's an example of why that market makes me nervous. So that's one that I know about. What do they have in China that I don't know about? Right, so a Western company is guiding, hey, we're going to wind this mine down, or it's reaching the end of its life. You don't know what you don't know about supply. So with these niche, and this would, there's people who are really interested in other sort of niche metals like this, and you can make an argument. Any one time I've seen like cases for titanium over the last 2 decades that I've been doing this, not every year, I wouldn't say that, but maybe every 2-3 years, somebody comes to me and says, oh, look at this, and they make this case for titanium, right? Or molybdenum, Molly had a spike recently, but that's gone away, right? But sometimes somebody will say, oh, here's this reason why Molly has to go, and then it just doesn't, right? A lot of these markets are they're opaque, the pricing isn't clear, the supply and demand is not clear, and periodically they present really exciting cases. I just don't have confidence in them. So I have never owned or bet on titanium, just as an example. I'm trying to think of the other one. What's that other really heavy one, like uranium but not uranium? Tungsten. Tungsten is very heavy. I remember, like, less often than titanium, maybe every 5 years, somebody comes and tells you, oh, this tungsten is going to rip because of XYZ reason, and it just never happens. Like, okay, that one time that Molly ripped earlier this year, I think that's the first time one of these Molly predictions has come true in 20 years in my experience.
All right, makes complete sense, and perhaps
I'm sorry I'm raining on your parade there, but that's my honest take.
Perfectly happy for that. I love that. And perhaps the answer will be exactly the same for graphite, which is a material I would also like to ask your views for.
It's in between. Like graphite it's a bigger market. It's not quite so niche, but it is, and opaque isn't the right word, but it's complicated. And there are metrics like flake size. If you're in the market, you know what I'm talking about. And to the audience, don't worry about it. But there is these things that, basically the bigger the flake size of your graphite, the better, the higher price you get for the product. But there's also, what's in the impurities and what form does it take? There's no spot market for this, right? And there isn't even like an LME clearing function. You're dealing with end users. When you put together a graphite project, before you even start doing your feasibility study, you're already talking to end users and offtake deals, because what your product will be depends on what that end user wants and what their requirements are in terms of levels of impurity and flake size and all this other stuff. It's going to vary from customer to customer. And some of these projects, they'll have like 100 potential customers lined up before they even start doing the feasibility to get a feel for what kind of product they need to make. So clearly there's money to be made in graphite. We use it in these batteries, right? There's demand out there. Somebody's going to mine graphite and make a lot of money doing it. But it's not fungible like gold or even oil. It's complicated. You really need to know your stuff. And, I have been pitched on a number of graphite stories over the year. And I've not bought shares in any of them, and not once has it ever taken off and have I said, oh man, I wish I had bought that. Every time I have not bought a graphite play, I've thought, oh man, I'm glad I didn't buy that one.
All right, excellent. Thank you again for roasting that material. Much appreciated. And perhaps we'll quickly touch base on gold before we transition to the real interesting stuff, the pre-production sweet spot, sorry. Perhaps you can quickly recapture what your thesis on gold is heading into that longer term time frame. Is it mostly devaluing of the dollar, or are there different mechanics behind that?
Longer term, yes. It's not just the dollar, all fiat currencies. I really don't call it the price of gold. I call it the gold dollar exchange rate. To me, it's not just a rhetorical flourish to say that gold is money. It is, always has been, and whatever government rules make or whatever, it's still money, and it's still a tier 1 asset. Even Basel III, right? Everybody knows it, whether they admit it or not, and therefore it's a forex question, whether it's the dollar or the euro or anything else. In my mind, it's not like pork bellies or even copper. So yeah, the governments of the world are devaluing their currencies, and so it's no surprise that we're seeing all-time highs in other currencies before the dollar, and now the dollar, king dollar. So it's all fitting the broader narrative. But I actually think that longer-term picture is almost irrelevant. I won't say unimportant, but it doesn't inform my investment theses or buying now. Like, I'm a bull on gold right now because recessions are good for gold, and my outlook is this hard landing outlook. So it fits with my current outlook. Are the BRICS going to have a gold-backed currency in 10 years? Is the dollar going to stop being the world's reserve currency 30? Like, none of that really helps me to decide what I'm going to put my money into right now. And by the way, my thesis at the beginning, or before this year, was not for the 2 yellow metals, it was for gold. And last year, my highest conviction trade was not gold, it was uranium. And I was right about uranium last year. I'm being right about gold, at least on the exchange rate this year, but the reasons for it were the hard landing, which still hasn't happened yet. So I haven't actually been right yet. Like, price-wise or exchange rate-wise, I've been right about gold, but I've been wrong as to the reasons why. Now, maybe I'm just a congenital optimist, or I believe my own BS too much, but actually this makes me more optimistic, because I thought that gold was going to go up this year because either the Fed was going to just cut rates anyway, or we're going to get that hard landing and the money helicopter was going to fly, and this was either good or very good for gold. That's still in front of us. That's just starting to happen now. But instead of going into that scenario from 1900 or 2000, we're going into that scenario from 2400, 2500. So, I don't want to sound too wild and crazy until tinfoil hat-ish, but a 20% gain from where we are now takes us within kissing distance of $3,000. It's not a prediction. I'm just pointing out the mathematical fact. A 20% rise in the gold dollar exchange rate, it's not a big deal. A gold breakout will often run, like in 1980 or 2010, 11, these things will go up like 50% in that hockey stick area. So a reasonably modest reaction to what I think is coming will generate crazy headlines. And I think for all those people that have been wondering why their gold stocks are underperforming, or if they're a broken asset class, are they ever going to get up and go? I think they will. I think either this time is different or they will, and I expect that they will, and I am putting my own money on that thesis.
Excellent. Definitely exciting heading into that latter half this year, seeing if we're going to have a hard landing. Not exciting from an equities perspective or from having a job perspective, but definitely if you own some bullion, if you own some gold, that could be that afterburner effect. 20% from this price point puts us at $3,000 an ounce. And perhaps we can transition to what we both find most interesting, and especially you as you're a fundamentalist. And we can talk about the pre-production sweet spot, which is something you coined a couple of months ago. I'm probably the 100th host that asked you about this, but could you shortly explain what it actually is so we can ask some questions about that?
Sure. Well, most of the audience is probably familiar with the Lassonde curve, which is sort of the share price over the life cycle of a junior exploration company, where you've got basically bupkis, and then there's a discovery if they're successful, and there's this big ramp up, and everybody loves a discovery. And then there's this boring engineering phase, as Doug Casey called it, or the orphan phase, while you're doing all these feasibility studies and all this boring technical stuff. And then there's a ramp up to production, and then question mark, does it become the next Newmont or Barrick, or does it mine itself out of existence in a few years and we never hear from it again, or whatever. So that's the Lassonde curve. And the pre-production sweet spot, I did not invent the name, it was always called that, but my claim to fame in the space is that, as far as I know, I'm the first one to actually collect data and measure it. And that's that rise in the second part. Like the first rise, everybody loves a discovery. The problem with that is nobody knows who's going to make a discovery. Not even Rick Rule or Doug Casey or Eric Sprott. That's why Eric Sprott buys like everything with silver in it or whatever, right? He could afford to buy them all and then bag the discovery there. Most people can't do that. So, it's really hard to nail that first part of the Lassonde curve or to get in before discovery. And I make no claim there. I don't have any pre-discovery exploration in my portfolio. Quick aside, that Lassonde curve, that first part, it's not a single day. It's not like you make a discovery and the stock goes up in a day. That does happen when they make the announcement, but there's a lot of work from that discovery hole to defining a 43101 compliant deposit, and that success along that path provides less risky and more reliable gains. And that's where I look. I call that success in progress. It's my other favorite investment besides the PPSS. So, second part of the Lassonde curve, everybody knew it was there, but the assumption was that, well, everybody can see who's building a mine, so it's priced in. There's not a lot of money to be made there. And it makes sense, it's not something you do in secret. And if you make a transition from literally pouring money into diamond drill holes in the ground to hope to find something, to getting money out of a big hole in the ground, mining, that transition should be rewarded. But since it's so visible, I remember I asked Doug what did he think it was. He said, I don't know, maybe 10 or 20%, like, a little bit of arbitrage. Well, we went and we did the math and we found cases, and it turns out it's more on the order of a double. And I won't go the whole story, but we've repeated this. We're expanding the database. I've rebuilt and expanded the database as the independent speculator. We now have 130 plus examples in this database. And since only a couple of these happen per year, I think it's actually most of the universe. It's not a very large number to do fancy statistics on, but I think it's not like a representative sample. I think we probably have half to 2/3 of all the cases of this type of transition in the last 30 years. So this is like real. And the average gain is around a double. And even there was some success in the last year and some failures in the last year. And even including that, the average gain is still on the order of a double. And during a bear market, it's only around 25-30%, but it even works in a bear market. So this is a very robust finding. It's hands down, when I can find a PPSS play I like, that's my favorite type of speculation.
All right, excellent. Thank you for that great comprehensive overview. And I guess what I wanted to ask you is how much of this is actually an arbitrage play where you're abusing the market's inefficiencies, or is it more of a value investment where you're buying something that's just discounted? You can look at the MPV, you know that it has a certain value, and you're taking the risk.
Yeah, well, I mean, I wouldn't think of it as arbitrage, but yes, markets are irrational. I'm really not a believer in the efficient market hypothesis. It's precisely because markets are so often so irrational. They get overbought, they get oversold, happens all the time. And that divergence between price and value is why speculation is even possible. Now, by that I mean Doug Casey style rational, disciplined speculation, not just wild gambling. So when your investment masters like Graham Dodd type, investment gurus from back in the day, when they dismiss speculation, you read Ben Graham when he talks about speculators, and he talks about people with get-rich-quick schemes. And he's basically talking about shysters and charlatans who come with these, oh yeah, I've got this system, just lend me your money and we'll all be millionaires, right? So I understand why he was so negative, but he never met somebody like Rick Rule, who is as disciplined as they get. I mean, I've frequently referred to him as like a laser-guided shark, just cold-blooded, goes for the kill, absolutely without error, right? So yeah, the markets are just not efficient. They overbuy, and that creates opportunity. In the pre-production sweet spot, there is execution risk. The other stat, I guess, is 95% of the companies that start to build their mine actually succeed. So it's a very high success rate, but some don't. And if you raise hundreds of millions of dollars and fail to build your mine, that's catastrophic. It's very hard to recover from something like that. So it's you can't just throw darts at a board here. You still want to do due diligence, still want to look at these things. As we get closer to the end of the pre-production sweet spot, though, and you can see, oh yeah, here's the trucks, they're mining. Here's the pit, it's already getting down towards the ore. Or here's the portal, right? It's built. Oh, there's the plant. This got giant ball mills in there. It's working, right? People, there's this excitement. So the largest gains in the pre-production sweet spot are in the final months as you ramp up to production. And I frankly think that really is just emotional. Like people see the pictures, they get excited. Ooh, it's going to be a gold mine, right? And so they just pile in. They just get excited. They see this is going to be built. Intuitively, the underlying value, like Misesi and regression, would be that transition I spoke of before. You're making a transition from spending money on exploration and development to making money from the mine. There should be a re-rate there once the technical and execution risk is gone. Then that discount should go away. But markets are not efficient or rational. And so, like before the mine gets built, there's this huge discount. Like it's common for these projects to trade, a quarter, a third of NPV. A really high profile, high margin one might trade for half or even more than half of NPV, but there's always a discount. And so if that discount goes away, you get paid. But then when it's starting to happen and people, they just get excited, they see the big yellow trucks and the little boy inside that played with Tonka trucks gets all excited and just start buying, and these stocks go higher probably than they should. Particularly since when you get to first pour and pour that first warm baby gold bar, it's so warm and cuddly, it's exciting, but you haven't actually made money yet. Right? That's actually when the rubber hits the road. After you start the mine, and a mine processing plant is basically a horrifically expensive, hundreds of millions of dollars chemistry set that you're going to shovel a bunch of dirt and rocks through and hope that something valuable comes out the other end. That's another Doug Caseyism. So the opportunity for things to go wrong is enormous, and if there's a failure in the mine build, you usually don't find out until after you build it. And this is the beauty of the pre-production sweet spot. It gives you a very clear entry point. We're building the mine. It's happening. Ooh. And an exit point. We've built the mine. And the exit point is not, oh, we're now a successful mining company making lots of money, because that's a question mark. The exit point is we've built the mine. And I get out before we find out whether or not the mine actually delivers as advertised. That's high risk. Remember what I said, 95% of them actually succeed at building the mine. So just building the mine is low risk. Building a mine that actually makes money, that's harder to do, especially if your feasibility study was done 2-3 years ago. The inflation numbers haven't been factored in, right? There's a lot of things that can go wrong over that time. So, I'm inclined to take the money and run before we find out whether the mine works. And then if it turns out that it does, and there's growth potential, then I would evaluate it as a producer. Okay, here's this new profitable producer. Where's the growth coming from? What's the value proposition? I would look at it as a fresh speculation at that time. But if you're going to go and play in the PPSS, remember, clear entry point, clear exit point. You get fancy with that, and you're likely to get burned.
All right, definitely good advice there. And perhaps also quickly to outline for the viewers at home, we're not just talking about an average mining company that has a PFS, a pre-feasibility study. There are some criteria for that starting point, correct?
Yes. Well, the most important one is that transition from spending money to making money. That only applies if you're an explorer, like you're not an active miner. You made this discovery, you're building the mine, so you're going from exploration to production. If you already have a mine and you make a new discovery, it's not a pre-PSS play, let alone a major miner, right? If Newmont brings another mine online, you may not even notice it in the share price. They've got scores of them around the world. So it only applies to companies that are not miners, are making that change from exploration development to production. And then yes, the PPSS isn't just, oh, we have a study or, oh, we have a deposit. The ducks all need to be aligned. And you need to have a feasibility study, or I want a feasibility study. And building a mine without a feasibility study is a big red flag in my view. Some of my worst investment outcomes have been betting on projects that look so simple they didn't need a full feasibility study. So feasibility study, finance, if the feasibility says we need $250,000 to build this mine, I want to see 300 million or more, right? I want the money in the bank. I want all the permits there. And then I want a construction decision, the board to give the formal green light with all the ducks in a row. That makes it a PPSS play. Until that point, you may be close, and maybe you could front run the PPSS and make a little bit more money, or maybe you find out that, there was an endangered mosquito on the property and they're never going to get that permit and you made a mistake. So the safe way to play the PPSS is to wait till all the ducks are in a row, and the formal decision has been made, and we are building this mine. And the one caveat I would say is that occasionally, not often, but you will get a board that might jump the gun, and they may decide to build the mine before the final permits are in. That's a red flag in my view. This recently happened with Valentine Lake because they discovered a new deposit after they were already starting and so on. But still, they really put major capital. They had progressed that mine, put hundreds of millions into the build before recently they finally got that last permit. Now that's been taken over, so the story's sort of out there. I'm not picking on the company, and maybe as management I would have done the same thing given how that goes. But that's an exception. I'm just saying in general, if you can't just say, oh, they say they're building the mine, so it's a PPSS play. I still want to see all the permits, all the money, right? All the ducks in a row, and that decision, so that we actually not just plan to do it, but have everything we need to do it.
Excellent. All ducks in a row makes complete sense. Then one more question before we start talking about your banner behind you. That's definitely something we have to squeeze in. But before that, perhaps you can quickly talk about what you're looking for an equity you want to invest in if it's not a PPSS play. What are the metrics that you care about? What do you look for? What kind of research do you do before you make that trigger to make that investment decision?
Okay, so basically I'm a value speculator. And the PPSS is an example of that. Like as we were just discussing, because of technical risk and execution, it's reasonable for a project to sell at a discount to NPV. So that there's a value proposition there. Now, you don't always have that luxury. You don't have the numbers to do that. So I mentioned before that success during the first part of the Lassonde curve, I call that success in progress. And by the way, to the viewer that doesn't know, this PPSS research, there's a free download on our website. We were going to go there, but just to mention, we've been talking about it. There's charts, there's examples, you can see the math in there. It's a free download. There's also one on the success in progress. If you type success in a little magnifying glass thing at the upper right, you can find that, where I walk through this thesis of, it takes time to go from that discovery hole to having a deposit. And if it's real, if the geologists have figured out it's a vein like this or it's a disseminated deposit like that, their drilling will have predictability. And when you see that starting to happen, I think there are maybe not much 10-bagger potential, but 3 or 4 or 5 times my money is fine, especially if the risk is much less than guessing who's going to make a discovery. If I did want to bet on pre-discovery exploration, and I don't do this, but I don't do it because I'm a newsletter writer and I have people looking over my shoulder saying, what have you done for me lately? So if I was a private investor, I would probably own a basket of prospect generators, because prospect generators, in my view, are the only rational way to invest on pre-discovery exploration. They put other people's money to work. It's not you getting diluted. If the project doesn't work out, you turn it over, look for another one, and it's other people's money that got spent figuring that out. So I just think that makes a whole lot of sense for pre-discovery exploration. And I don't have them in the newsletter because it can take years for that to work out. It could take 5-10 years, and then it happens. But that's the way to go for the patient. I also am open to, we talked about after the PPSS, if a company builds a great mine, they're successful and they're making money, and now we're growing. Like if I can see an emerging producer that they built, they have 3 or 4 projects, they built the first one, picked the low-hanging fruit, but now they have all this other value and they have the cash flow to develop that becomes very interesting to me. And again, it's not like super high risk like exploration. These discoveries are already there. We know that there's potential value, and now the company has the wherewithal to pursue it without having to get taken over or dilute shareholders by bringing in some major partner to do most of the work or something. So stories like that can get my interest. Another thing, just as a value speculator, and this requires a bit of patience too, is markets fluctuate. Right? They go cyclical highs, cyclical lows. If you take the blue chips in the space and you just wait for these crazy moments, like we were talking earlier about something is on sale, stupid cheap prices. Who cares where the bottom is? If these are the top names in whichever space you like, and there's no threat to them as a going concern, but they're just on sale because it's Black Monday or whatever, the mining space is volatile enough that even with the biggest names in the space, you can get doubles or triples if you buy those near, cyclical lows and then, sell them when everybody loves them. So, and that's highly reliable. That is very, very low risk. That is about as low risk as it gets in the mining space. And I don't want to name names, though right now we're not at a cyclical low for the gold miners, but you know who I'm talking about, and the royalty plays and so on. If you can tick those at a 52-week low, the odds are very much in your favor if you're not going into a bear market that you will make money. And that's the type of opportunity that I look for.
All right. Thank you so much for your time and your comprehensive overview, Lobo. Really appreciate it. And of course, we also have to talk about your banner. You already started hinting at it, your newsletter. Perhaps you can quickly pitch to the viewers at home and take your time if you want to tell what it's all about.
Well, I'll keep it simple. You hear what I do. I'm a due diligence guy. I have a free weekly letter. That's the main sales pitch here. It's free. And I can't promise you'll like it. I can't promise I'll make you money. But I do promise that if you sign up, I will not flood you with, a giant barrage of daily advertisements. I hate that stuff. You get one email per week. You can see how I think, decide whether or not you want me to be your due diligence guy through my paid publications.
Excellent. Lobo, thank you so much for your time. Really appreciate it.
Thank you.